As an investor, it is often better to travel than to arrive. It was telling last week, for example, that the U.S. stock market hit a set of new records on the day before Congress approved President Donald Trump's tax reforms. Investors are good at pricing in positive developments ahead of time. Once the event itself is in the headlines, the smart money has already moved on. It is likely that the corporate and individual tax cuts announced before Christmas will give U.S. company earnings a short-term fillip. But the net effect of the reduction in the corporate tax rate from 35% to 21% is less than meets the eye, because few of the big companies that dominate the stock market indices actually pay the headline rate. The average increase in earnings, as a result of the cut, will likely be no more than about 6%. That will help to justify the current level of the U.S. stock market, and may prolong and extend the bull market a little. Before the cuts were confirmed, 2,700 looked a sensible level for the S&P 500. Maybe the target should be 2,850 now. It's hardly a game changer. Valuations have got a little bit less stretched, that's all. The more interesting impact will be at the sector level, where some of the most highly taxed areas, such as energy and financials, should see some ongoing benefit. Financials, in particular, will enjoy a double whammy if the dollar's $1.5 trillion, 10-year stimulus leads, as it should, to a slightly higher interest rate trajectory. More profitable lending and a bigger slice of those profits remaining with shareholders is a good combination. So, my view of equities in 2018 is not much changed. The drivers of the 9-year bull market are largely played out, but, in the absence of recession or runaway inflation next year, I see no reason to expect a material change of direction in the stock market. After a year in which there has been almost no volatility, a correction is overdue. But I don't believe it will turn into anything worse. A sideways moving market is a distinct possibility in 2018, with a slice of next year's expected returns brought forward into what was an unexpectedly good year for investors in 2017. In such an environment, picking winners and avoiding losers will be rewarded. Passively tracking the index at this late stage in the cycle makes no sense. Choosing the right countries to invest in will also pay off, as currency moves might have a greater influence than they did in 2017. A stronger dollar on the back of higher interest rates will provide a tailwind to both the European and Japanese stock markets. These are the most interesting destinations for investors next year, with positive earnings growth, supportive central banks and more reasonable valuations a winning cocktail. The other market that is looking interesting to contrarian investors is the UK. It missed out on the party in 2017 as investors fretted about Brexit. On one level that made sense because the economy has certainly lost momentum. But, as we know, the London market is peculiarly international. A synchronized global economic recovery and a weaker pound versus the dollar might allow the UK market to play catch-up in 2018.